Hi, everyone. So, another episode of Property Pursuits. Am I good to start? Okay, so I'm back with a market update. A little different today. I don't have a guest. Hopefully, I won't bore you guys, but I have a lot of really interesting information to go over, considering that interest rates are not exactly where any of us wanted them to be right now. And I think there's some challenges to affordability that go well beyond interest rates. So, today I want to get into a lot of this stuff. Here's a quick preview of what we'll be covering today. We're going to work through this as quickly as we can, mainly because I'm hungry, but two, because I know you don't want to be here all day. I want to talk about what rates have done historically. I want to talk about a whole new demographic of buyers who's being wrongfully denied loans and some of the solutions they could use, from the non-QM, which I'll explain what that means, to regular traditional Fannie, Freddie, FHA options that their banker might not have been aware of and, like I said, wrongfully denied their loan. So let's jump right into it. The history about interest rates. And I know you think you know what I'm about to say, but you don't. Because this is a little bit more multifaceted than it's usually explained. So the median interest rate on a 30-year fix, since we've been tracking this, is in the sevens. And I know that everyone's sick of hearing, well, interest rates were 18% when I bought my house, and back in my day when you wanted to buy a house, it was uphill both ways. That's not what I'm trying to say here. But what I am trying to say is that the anomaly was interest rates as 2 to 3%. As millennials, young adults, right now we think, that was the best time to buy a home. That was the only time to buy a home. We missed the boat. If we didn't buy a home when interest rates were 2 to 3%, we're never going to catch up. While it was an amazing time in some senses, in others it wasn't. And most importantly, it's not likely to ever be that way again. I don't have a crystal ball, but seeing interest rates at 2% again is not going to likely happen in my career as a mortgage lender. And so it's probably not going to happen for you in time for you to buy a home. So that's why I'm pointing out that the median interest rate was about 7.31% over all this time. And what's interesting is that in the 90s, homeownership actually increased. 63.9% to 66.8% doesn't seem like a huge increase, but it actually is when you take into account the population it's measuring, and the interest rates at that time were above 7%. And I think it's because of what I started this year saying, that 2026 would be one of your last best entry points into the housing market. Because even though interest rates are elevated, your competition is slightly thinner and you have more negotiating power. Plus, there's a whole level of uncertainty that plays into markets like this that gives you the upper hand over sellers. So if you're willing to be active right now, if you can qualify to buy a home, it's an amazing opportunity. And that's why today I wanted to focus on helping people qualify who've been told otherwise that they can't. But a couple of things to touch on before I wrap up this history lesson on interest rates. Back in the day, and for the majority of my time as a loan officer, except for the anomaly of 2 years, people focused on their monthly payment, not so much the interest rate and not so much the price. They focused on what they would actually feel every month when they lived in that home. And that was when they paid their mortgage. So having a payment first mentality really changes the psychology of buying, because it's not about, winning, drawing blood in some death bidding war. It's also not about what interest rate, because you're never going to think really about that interest rate ever again. Once you brag about it on the golf course a couple times, it's over. You just make your payment every month. And from a conservative standpoint, that's also the most important part, that you can afford that monthly payment. I think we really need to get back to a payment first mentality. And then the whole marry the house, date the rate, that's silly. Don't buy a house banking on a refinance, because I don't know when it's going to come. I can tell you for sure it's going to come. I have no problem putting my ass on the line to say you will most likely refinance. And you know why? Not because of any promised rate cuts, not because we're now looking at rate hikes. The reason that I'm confident you will do so is because historically, the average American keeps a loan 6 to 8 years. They will refinance or sell once every 6 to 8 years. When we factor in the anomaly years of the 2 to 3% interest rates and the golden handcuffs they put on people, that average has increased from 6 to 10 years. But it's still a lot of people doing it as soon as 6 years, and definitely most doing it under 10 years. You're not going to keep a loan 30 years. You don't need to be in love with the interest rate. You need to get into a house where you can start building wealth. And that's why I'm assuming you're watching this right now. So let's get into it more. Who is this modern earner, and why did I make up this whole demographic of people? It's because people aren't making money in the same ways anymore. And I'm not talking about OnlyFans. I am talking about influencers. I'm totally talking about people who have chosen to leave the corporate world, start their own business, become an independent contractor, make money in different ways that give them more freedom. That is a growing demographic of people in today's world. Less and less are we seeing buyers who work a typical 9 to 5, who have a steady paycheck, their income beautifully reported on a simple W-2. Even if they are getting a W-2, it probably has some stock award income. It probably includes a ton of variable income in the form of bonuses, overtime, differential pay. The people who can afford to buy homes today, their income is very unlikely to fit cleanly on a pay stub and W-2. But unfortunately, the traditional mortgage system was kind of built for that W-2 employee. Now we're looking at the modern earner, people making money in new ways today, and the system is trying to catch up. It really is. And that's why I'm going to go over a lot of what I'm covering today. People's financial situation has not gotten too complicated to buy a home, but it has gotten too complicated for the basic call center loan officer and maybe for your banker too. Because you're equity rich, you're cash flow positive, you have maybe a ton of money in the bank, but not a ton of money on your paycheck. Maybe you recently made a ton of money from AI. Maybe your crypto has done really well, and now you've had it long enough that it's even reporting on your tax returns. There's a lot of wealth in America that lives outside of a W-2 box, but the system is a little bit harder to navigate for these modern earners, and I think we need to change that. I think the modern earner being wrongfully denied a mortgage is actually a bigger barrier to affordability right now, is actually stopping more people from buying homes than interest rates. And I know that's a bold stance, but home buyers don't always look rich on paper, but they could get rich owning a home. Okay, so let me get into 3 examples of a wrongful denial on a mortgage. Recently, I had a tech founder who had started a company, and he had been just finished his 3rd round of venture capital funding. So in the first 2 rounds, his company started taking off. They started doing really well. He was still taking just a very bare minimum salary from his contract as the founder. The company was supposed to reach a certain level of funding and sales before he was going to take his full salary. And he had been denied by another bank. They just told him there's no way. You're self-employed. We cannot use the income you're paying yourself now this year because it has not yet been reported on a pay stub or W-2. That's actually not true. Freddie Mac has a guideline where we can use the current income that is being reported on your salary, on your pay stubs, even if you're self-employed, even if you haven't filed a tax return for that business yet, we can use the new increase as long as we get a CPA audited P&L. You learn something new every day. This guy was going to be directed to a non-QM loan. He was going to be wrongfully denied a loan altogether. But there's this clear path to closing. You just have to get really in the weeds on the guides. Then there's the write-offs. You started a business most likely. If you're watching this and you're self-employed, then you understand something that a lot of Americans don't. And that is that the tax code is a contract we all sign with the US government, but very few of us understand it. And it was truly written for the benefit of entrepreneurs and real estate investors. And it was written so that when they follow it closely and intelligently, they could actually live tax-free and fund a more capitalist economy where people put their money into the economy rather than waiting for the government to fund its infrastructure. I know I'm getting into the weeds here, but the truth is business owners start businesses so that they can have write-offs. And then there's the mortgage banker annoying the shit out of their CPA saying, hey, you need to show this much income for our mutual client to qualify. And that sucks because in order for them to show that income, they're going to pay the IRS a lot more money. And there's all kinds of scripts out there for loan officers, for those bankers to tell you, you're going to have to bend over for the IRS just this 1 year, maybe 2, but then you'll own a home and it's going to build you so much wealth. The second half of that is true, but maybe you'd be better off using a non-QM loan, even if the interest rate was slightly higher, because it would cost you less than what you're going to pay the IRS, and you could get in sooner and you could build wealth faster, not having to wait for 2 years of tax returns showing increased income. There are a lot of programs for self-employed borrowers, and I'll get more into them. Another example of a wrongful denial is Fannie and Freddie have a limit on how many mortgages you can have. Once you have 10, they stop wanting to finance you because there's too many layers of risk there. So a lot of times these investors think now they have to go to private money or they have to start paying cash. And that's simply not true. There are investor-specific loans, DSCR loans, and there's also exceptions that can be requested from the Fannie and Freddie guideline. So let me get into just some of these. I'm not expecting you to underwrite yourself using the information you learn in this podcast today. Later on, I will give you a link. We can have a one-on-one conversation. We can analyze your position, your income, your specifics, personally and privately. The reason I'm running through some of these guidelines and loan programs is to get the wheels turning in your head about what might work for you, why you might have been wrongfully denied, or if you're a realtor watching this, the clients that you should be thinking of who should be getting into homes using one of these programs. So a bank statement loan is really cool because we analyze the cash flow into your bank account to see what you qualify for. So typically, as a business owner, we would have looked at your AGI, your adjusted gross income on your tax returns. Maybe you file a Schedule C. We could have added back a couple things like depreciation, depletion. We could have added back in business use of your home. That gives us some buying power back, right, for deductions that you could have taken. But maybe it wasn't enough. Maybe you also file a whole separate business return. Of course, we're going to go through that with a fine-tooth comb, make sure we're giving you credit for the salary you're paying yourself, again, for depreciation. We'll add back everything we can per Fannie and Freddie guidelines. But if it's still not working, then getting into a non-QM loan, like a bank statement loan, is really worth considering. Because instead of looking at your tax return, we're going to look at the cash flow of the business. We're going to analyze your business accounts, or if you use your personal account for this, it's not a deal breaker either. We're going to analyze that and see what the monthly receipts are for the business before any write-offs. So what are we going to use for an expense ratio? Get this, my friends, a letter from your CPA telling us what to use. Should we use 10%? Should we use 20%? Your CPA will tell us what your expenses are typically like. That's freaking amazing. And then that'll be the expense ratio we take against the monthly deposits average on your bank statements, and we have your qualifying income to shop for a home. It is super cool and something that I think more people should be using to qualify before they just go ahead and ditch all their write-offs and give all their money to the IRS. For my investors out there, I mentioned that the tax code was also written for you. That if you can use real estate investing the way you were supposed to, the way the tax code was written, you could live tax-free. You could donate all the money you want to charity every year. But sometimes, if you're doing it well and you are using the tax code to your advantage, you're taking some pretty big active losses, or you've hit the limit on having 10 mortgages. This is where a debt service coverage ratio is really awesome. And by the way, most lenders don't do this, but you can use it for a first-time investor, buying your first rental property, if that's what you're doing. So maybe you're a business owner who doesn't claim a lot of business income. You got into your home before when you were a W-2 employee. Now you're thinking, okay, I'm already building wealth with my business, getting amazing tax advantages. Let me take this one step further because now my business is getting really profitable even beyond what I'm able to write off. Why my CPA says I should look at buying some real estate every year, but I can't qualify traditionally. Use a DSCR loan because we're just going to underwrite the property to make sure it cash flows itself. Debt service coverage ratio. If the rent covers the mortgage, including taxes, insurance, and any HOA that might be applicable, you are good to go. We underwrite just the property itself. We don't look at your tax returns. We don't pull your tax transcripts. We don't have to get all of your rent rolls for your other properties. We're just going to underwrite the subject property that you're purchasing and make sure it's going to cash flow at least a ratio of 1. The interest rates get better if it's going to cash flow more positive than that. So again, no W-2, no tax returns. A debt to income ratio is not even in the folder. It's not even on the file. It's blank. It's the most magical thing ever. I'm sure you're thinking these rates are ridiculous and they never work. It's actually not true at all. So conventional interest rates right now are around 6.5%. You're looking at maybe just under 7% for a DSCR loan. It's not a big deal. Okay, and then coming back to the guidelines, because I think this is a really, really big deal. Now, a significant portion of who I'm calling the modern earner is wrongfully disqualified. And I'm saying that, like I'm making it dramatic and I'm saying that word like I'm It's intended. It's intended to sound as bad as wrongfully disqualified implies. But it's because it sucks. If you qualified and you could have bought a home last year and you got told no by a lender and you've been waiting to get a new tax return in, then you've been wasting a lot of money on rent. You've been running your business in a different way than you typically would have. Like, there's far-reaching impacts to being told no when the answer should have been yes. So drama is intended there. But like I mentioned with that tech founder who had gone through multiple rounds of venture capital funding, there's guidelines that we can use that maybe not every call center, loan officer, or banker is aware of. Maybe they're not going that deep into the file because they're playing more of a numbers game and looking for easier, low-hanging fruit in terms of borrowers. Self-employed, I mentioned, there's things we can add back in. We add back in a lot of your business expenses as much as we can. We give you credit for write-offs because we understand that the way the IRS views income is different than qualifying income. And that's not fraud. That's just a fact, the way it was written. FHA loans, this is insane, you guys. You could have a non-occupying co-borrower, boost your buying power. You can have, here's a crazy story. So I had somebody who, if you have made a late payment on a mortgage within the last year, you're typically disqualified from financing. You need to have 12 months of clean mortgage history. But there was someone, a borrower I love dearly, and they had some medical extenuating circumstances. And they missed not one, not two, not three, but they had 4 mortgage rates on their credit. Now, any other lender probably would have denied them because even if they knew about the extenuating circumstances loophole, they probably would have read the guideline thinking you can only exclude 1 late using an extenuating circumstance. Here's the thing though, you can actually exclude them all if they're all tied to the same extenuating circumstance that you can properly document. Not fraud, you have to document it. You have to show the extenuating circumstance, has to line up timing-wise with those late payments. But this person was able to get an FHA loan and close on a home and get their life back on track after some pretty gnarly medical stuff. There's also extenuating circumstances for financial circumstances. There's all kinds of ways to get an FHA loan done, even using a manual underwrite. A lot of lenders are scared of the word manual underwrite, but sometimes it's the best path to closing for a borrower. And if we can't make it work FHA, we can't make it work even VA, there's another program called an earned equity program. Now, I don't want you to get all squirmy because I know that sounds like a lease to own. And technically it is. But the earned equity program is going to get you into that home. You'll later assume the loan from the entity that bought it on your behalf, but you get to keep all of the appreciation that's been built, the equity that's been earned during the time that you were technically leasing the property. And during that time, you might be repairing your credit or establishing a 2-year job history or whatever it's going to take for you to qualify for an FHA loan or a conventional loan. And then you take over that and you own the property at a price from maybe 2 years ago. And since then, prices have gone up. I think it's absolutely worthwhile considering. And I will pause here to say, there's a lot of people listening right now who are going to say, if you don't qualify traditionally, then you have no business buying a home. You shouldn't do it. You're going to default. And I disagree. I believe that home ownership changes your financial future. It'll provide stability to you that will impact your mental health, that will impact your finances, that will impact your job prospects. It is a good thing for the entire family, the entire neighborhood, the entire ecosystem when people own homes. That's why it's called the American Dream, and I believe we should help as many people as possible accomplish it. So your takeaways today. Again, I was not expecting you to learn all the guidelines and qualify yourself. That's what I'm here for. But I wanted you to have the right questions to ask. I wanted to get the wheels turning. I want you to be inspired about yourself or someone you know who could qualify for a loan, even though they don't think so. So we're going to stop defaulting to I don't qualify before you ask the right questions. Also, we're going to make sure that we can't qualify traditionally before we go to a non-QM product. But if we do go to a non-QM product, we're going to understand this is a long-term play. Finding a path to closing is the most important strategy so that you break in, so that you start gaining those appreciation gains, those amortization gains, so that you can start building the wealth. And we have to remember, interest rate's important. I'm never going to tell you that it doesn't matter because it does. It determines your monthly payment. But that's why I want you to be payment focused. The interest rate is just the context. It is not a flashing red light. It is not a crisis. It is not a signal to abort all your plans to buy this year. It's just context that is going to impact the market, that does impact your ability to negotiate, and that should inform your strategy, but not be the entire strategy. And again, wealth is not built by giving the IRS all your money. And I'm never going to be the lender who tells you that you just need to wait and file 2 tax returns and claim all this income and pay all this money in a tax liability. There's better solutions out there. Now, I put out a lot of content about this stuff. I write a weekly blog. I also share daily on Instagram, but you get access to everything in one place if you're in the inner circle. Most likely you are if you're watching this live, but if you're watching a replay on YouTube or on Instagram, join the circle. The link is in my bio or on your screen right now, and you'll get all the information as soon as I release it. Plus, heads up on special events we're doing online or in person here in Reno. It's a fun place to be, and it's also a really cool place to meet other buyers, sellers, industry professionals, or people who are just there for personal development. As I mentioned before, I'm happy to do a one-on-one call with you if you want to get into your specifics, even if you're not really ready to open your finances for me, but you just have some broad, high-level questions. I'm happy to do that too. You could book as little as 15 minutes with me via Zoom, over the phone, or here in the office. And I would love if you gave me a follow on Instagram because, like I said, I'm putting out content there daily. I'm always looking to grow that audience, and I think you'll get a lot out of it, and we can have a two-way friendship. But in closing, the modern earner can afford to buy a home, guys. There's nothing wrong with the way you've changed to making money. There's nothing wrong if you don't want to be tied to a desk 9 to 5. I get it. The world has evolved. So have your finances and your job prospects. You can still get a mortgage, and you should, because it is still an amazing way to build wealth in America. So you just need the right information. If you have questions, you can reach out personally. You can drop them in the chat. But I hope to stay in touch with you. Thanks for tuning in today.